Just a lot of volatility out there, and a lot of folks are looking for some guidance about how to navigate some of these markets here. So that's why we turn to the pros like David Bahnsen. He's a chief investment officer at the Bahnsen Group. David, how are you communicating with your clients here today? What is the message as we see these big swings in the markets?
We are communicating early and often. That's how we're communicating. lots of stuff to say. And it's really addressing stock market, bond market, macroeconomic. I've decided to try to do a lot, even evaluating small business implications. It doesn't affect investors day by day in terms of the bottom of their screens, but it's going to have a lot to do with where we go Q3 in the economy. So we're trying to look at all aspects and give our clients a full perspective as to why we're doing what we're doing.
Let's talk about the week that was last week. Like Paul said, there was a lot of volatility, a lot of headlines. China made up a large portion of the news flow. David, do you think that investors really should be focused on everything that happens in China and forget the tariff news when it comes to the other 70 countries?
Well, I think that the tariff news in China is the biggest story, and I think that there will end up being a combination of cosmetic victories and perhaps some substantive victories with these other 70 countries. When I say cosmetic, I mean probably deals we would have gotten anyways. And then again, I'm hopeful that there'll be some better deals, meaning less impediments to trade with the other 70. China's the big elephant in the room. And of course, I happen to believe this is the way that the administration should have done it to begin with. I think they had more political capital to isolate China, but it isn't a non-story. Just because it's more popular to go after China with the American people than it is to go after Switzerland and some of these other things they were doing, there's still a big economic impact. And so understanding where we're headed on the China side, we're by no means out of the woods there. There's a lot of uncertainty, and you've even seen a back and forth and different confusion over the weekend as to what's happening with some of these computer and semiconductor and smartphone exemptions. So lots ahead of us in that regard.
So, David, specifically, what are you telling your clients here? Are you buying the dip? Are you going to quality? Or increasing your allocation to fixed income, or are you just going all into gold?
Definitely not the latter. And one of the beauties of being a dividend growth investor, Paul, is that we're already in quality, so we don't have to go to quality. We just really strongly believe that you want to find those companies that are paying sustainably growing dividends. When I say sustainably, I mean including in things like a trade war. That's a very hard criteria to meet. And the companies that were able to sustain a growing dividend through COVID, through the global financial crisis, through all of these different areas of trauma over the last 25 years, it's a limited universe. But that's what we're focused on, and that's what we want people focused on now. The good news is that some companies, even in the dividend growth space, got cheaper. Some of the more cyclical financial type companies, they came down a little bit. Some of the energy companies came down, and I think that's good news. It gives people a chance to buy more at lower prices. And yes, we've been heavily buying through that period. What we haven't done is try to bottom pick on the NASDAQ or other types of companies that we think started this trade war with a valuation problem.
What about sector levels? There are some, I guess, investors out there that are trying to really pick stocks where there's going to be a benefit if there's more manufacturing in the U.S., if there's more reshoring. Does that come into play when you're picking dividend growers? I feel like the themes are similar, but...
Well, I think I understand what you're asking, but I don't know how somebody could predict what companies are going to benefit by more onshoring other than a broader infrastructure theme, which should benefit even apart from this. So we own a company, BIPC, the Brookfield Infrastructure, but that has a data center story, that has a pipeline, that has a number of other elements. If you're just simply trying to find companies that build factories, I think that that's a much more limited space. And it's a much longer term play. And I don't know that there's any clear indication that we are seeing some of that. That's sort of the challenge and ambiguity about the administration's priorities is we're not really clear what they're trying to get to. Are we trying to get to better deals? in which case you're not going to see more onshoring? Or are we trying to get to no deals, in which case they're trying to force more onshoring? And then if you get that onshoring, what does it mean for our export-oriented companies? In other words, does one hand giveth and the other hand taketh away? So we're not trying to set investment policy around administration policy. I don't think anybody should. We think that there's a little more dependability in focusing on these bottom-up fundamentals of the companies that we own and not looking to speculate on what the administration is going to do next week or even next year.
David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Bahnsen, he's the Chief Investment Officer at the Bahnsen Group out there in Newport Beach, California is where he is based.